What if you could sit in the same room with Warren Buffett and Charlie Munger, two of the greatest investors of all time, and listen to them share decades of financial wisdom, straight from the heart? No scripts, no fluff. In this video, we're diving into Buffett and Munger, Unscripted, a book that distills over 30 years of Berkshire Hathaway's legendary shareholder meetings into simple, powerful lessons anyone can apply. Whether you're a seasoned investor or just getting started, let's decode the mindset, strategies, and timeless truths that built one of the most successful investment empires in history. Stay tuned. This might just change the way you think about money forever. Hi there, and welcome back to Lean Reads, the channel where we share powerful insights and personal growth lessons through great books. If you enjoy what you hear and want to dive deeper, we've included a link to the book in the description below. Now let's get started. Buffett and Munger Unscripted distills clear, practical investing lessons from over 3 decades of Berkshire Hathaway's legendary shareholder meetings. Rather than focusing on complex financial strategies, the book highlights a successful investment mindset rooted in fundamental business principles. Through the wisdom and real-world insights of Warren Buffett and Charlie Munger, readers will learn how to think clearly, evaluate opportunities, and make confident, intelligent investment decisions. Warren E. Buffett is the CEO of Berkshire Hathaway and one of the most successful investors in the world, with a net worth exceeding $100 billion. His annual shareholder letters and the book, The Essays of Warren Buffett, are considered essential reading for investors worldwide. Charlie Munger was the longtime vice chairman of Berkshire Hathaway and Buffett's closest business partner. Known for his sharp, multidisciplinary thinking, he played a key role in shaping Berkshire's investment philosophy. Alex Morris is an investment analyst and founder of TSOH Investment Research Service. He's contributed significantly to translating Buffett and Munger's investment thinking for a new generation of investors. Imagine sitting in a room with Warren E. Buffett and Charlie Munger, two of the greatest investors of all time, as they engage in a candid conversation. For more than 30 years, the annual meetings of Berkshire Hathaway have offered millions of people the rare chance to hear these two icons speak unscripted, sharing their insights with honesty, clarity, and depth. What sets Buffett and Munger apart is the elegant simplicity of their thinking. Unlike the often convoluted, jargon-heavy strategies of Wall Street, their approach is grounded in timeless business fundamentals and a deep understanding of human behavior. Their way of communicating is both brilliant and humorous, turning complex topics into accessible, insightful lessons. It's like attending a real-world masterclass in clear thinking and long-term value. Whether they're breaking down market trends, explaining why most investors overcomplicate things, or warning against herd mentality, Buffett and Munger consistently show how simplicity and sound reasoning can cut through the noise. This concise volume distills the most valuable lessons from hundreds of hours of conversation over 3 decades. You'll learn how to properly value businesses, allocate capital wisely, and make smart, disciplined investment decisions. If you're ready to learn from two of the sharpest minds in investing, then let's dive in. When it comes to investing, Warren Buffett consistently emphasizes one core principle. Successful investing starts with a deep understanding of the business, not with trying to predict short-term stock market movements. At Berkshire Hathaway's annual shareholder meetings, this philosophy is explained in relatable, practical terms, often backed by real-world examples of investments that have generated massive returns for the company. One standout case is the 1972 acquisition of See's Candies. Buffett didn't rely on complicated financial models or try to forecast short-term trends. Instead, he asked a seemingly simple question. If a competitor had $100 million, could they displace See's dominance in the California market? The answer was no. That insight revealed CS had a durable competitive advantage, a key factor that has since generated over $2 billion in profit for Berkshire Hathaway. This example illustrates a concept Buffett refers to as the circle of competence, a fundamental part of smart investing. You don't need to know everything about every industry. You just need to clearly define what you do understand and stay within that zone. Buffett compares it to baseball. You don't have to swing at every pitch, just wait for the perfect one in your strike zone. A perfect example of this was his discovery of Geico's potential in 1951. He spent countless hours researching the business, because he understood its model and could confidently predict its long-term success. These lessons shaped what Buffett calls a time horizon mindset, a guiding philosophy behind all his investment decisions. In the short term, the market is like a voting machine driven by sentiment, hype, and ever-changing expectations. But over the long term, it acts as a weighing machine, measuring the true value of each business. That's why Buffett doesn't obsess over daily price swings. Instead, he focuses on long-term fundamentals and sustainable advantages. His investment in Coca-Cola is a prime example. In early 1988, Berkshire Hathaway began buying shares at $11 apiece, while many investors hesitated at that price. Buffett looked past quarterly results and recognized the company's enduring strengths and global growth potential. By 2023, those shares had increased more than 20-fold, proving that owning quality businesses and having the patience to hold them can lead to exponential wealth over time. This leads to a new way of thinking about investing. Think like a business owner, not a stock trader. When you buy a stock, you'll be buying a piece of a real company, not just a ticker symbol or a number on a screen. So choose businesses with solid foundations, clear future prospects, and stable operations rather than chasing market trends. That's why Buffett spends his time reading annual reports and studying business models, not watching stock charts or guessing market movements. All of this points to one timeless investment strategy: build wealth through understanding, stay grounded in core principles, and take a long-term view. As Buffett often says, investment success doesn't require genius. It requires discipline, patience, and an unwavering commitment to sound principles. Once you have a solid grasp of a company's fundamentals, valuation becomes the cornerstone of smart investing. At Berkshire Hathaway's annual meetings, Warren Buffett and Charlie Munger often remind us, if you need a computer or a complex financial model to figure out a company's value, you're probably overcomplicating things. According to them, a few simple estimates of future cash flows, combined with patience to wait for the right price, are all it takes to make sound investment decisions. Buffett often refers to a classic Aesop fable to explain the concept of intrinsic value. A bird in the hand is worth two in the bush, but he adds a twist, a sup, left out two key factors. When you catch the two birds, and what interest rate applies at that time. That kind of thinking allowed Buffett and Munger to spot opportunities like their iconic purchase of C.S. Candies in 1972. While traditional financial metrics didn't fully capture the company's potential, they recognized its ability to generate steady, predictable cash flow. C.S. Candies wasn't a business that could reinvest large sums at high returns, but the consistent cash it produced gave Berkshire the flexibility to allocate capital to other higher return ventures. It's a simple business, yet one that created enormous long-term value, proving that focusing on real business value, rather than just metrics like return on capital or growth rates, leads to sustainable results. Buffett and Munger look beyond the numbers when evaluating a business. While many investors obsess over P/E ratios or book values, they pay equal attention to a company's competitive edge and the quality of its leadership. Experience has taught them that it's often better to buy a great business at a fair price than a mediocre one at a bargain. At the heart of their approach is the idea of a margin of safety. They only invest when the market price is significantly below a company's intrinsic value, creating a buffer for potential miscalculations. Buffett likens this to driving a truck across a bridge. If the bridge has a weight limit of 10,000 pounds, it's risky to load it with 9,800 pounds. But with just 4,000 pounds, you'll cross with confidence. That kind of caution has allowed Berkshire to thrive even during times of economic crisis. For instance, during the 1973-74 recession, when many investors panicked, Berkshire focused on finding solid businesses temporarily undervalued by the market. The strength of this method lies in its simplicity and clarity. Valuing a company doesn't need to be perfect, it just needs to make sense at a big picture level. With businesses like C's, there's no need for complicated spreadsheets. What matters is recognizing brand strength, customer loyalty, and steady demand. These are the guiding stars of Berkshire Hathaway's long-term investment strategy. Once you've identified a company that's clearly undervalued by the market, the next step is deciding how to allocate capital. The key is having a disciplined valuation framework. With the right principles in place, making decisions becomes second nature. As Charlie Munger bluntly put it, it's not supposed to be easy. If investing feels simple to you, chances are you haven't yet grasped how hard it is to maintain discipline amid the market's temptations. But once investors answer the question, what should I invest in, correctly, the question of how much should I invest often answers itself. Getting valuation right is only the beginning. Once a great investment opportunity appears, the real question becomes, how do you deploy capital wisely? At Berkshire Hathaway, Warren E. Buffett, Charlie Munger, and Alex Morris have developed a disciplined and systematic approach to capital allocation. It's built around three pillars: understanding opportunity cost, setting clear investment criteria, and staying committed to capital preservation. This approach helped transform Berkshire from a struggling textile company into one of the most influential businesses in the world. It all starts with opportunity cost, a concept that influences every capital decision at Berkshire. Whenever a potential investment comes up, the question they ask is simple yet powerful. Is this the best possible option among everything else we could do? This level of discipline allowed them to make bold moves during the 2008 financial crisis. While most companies were tightening their belts, Berkshire confidently poured billions of dollars into major financial institutions like Goldman Sachs and General Electric. It wasn't just the attractive investment terms that sealed the deal. It was the fact that these options clearly outshone anything else available at the time. The second pillar is having strict investment criteria, especially when it comes to share buyback scenario, where many companies tend to go astray. Lots of firms repurchase stock without seriously considering the current price, but not Berkshire. They only buy back shares when the market price is significantly below intrinsic value. In 2012, Buffett made it official. Berkshire would only repurchase shares when they were priced below 120% of book value. That threshold ensured that every dollar spent on buybacks truly benefited existing shareholders. By sticking to this rule, Berkshire avoided expensive or ineffective repurchases that have tripped up many other companies. The third key element is a deep commitment to capital preservation, a mindset evident in every acquisition Berkshire makes. Rather than chasing rapid growth companies or businesses that could be optimized by slashing costs, they focus on acquiring stable, durable companies they can hold for the long haul. Take the CS Candies acquisition in 1972. Berkshire didn't overhaul leadership or impose a harsh restructuring plan. Instead, they trusted the existing management team and let them keep doing what they did best. This light-touch approach built strong relationships and earned the trust of many family-owned businesses, giving Berkshire access to deals few rivals could match. Another standout example of smart capital preservation is Berkshire's 1967 acquisition of National Indemnity, an insurance company. At the time, the insurance industry was under heavy stress. Rather than chasing revenue by taking on unprofitable policies, National Indemnity cut its business volume by as much as 80%. That patience protected their capital, and when the market eventually rebounded, they were ready to seize the moment, turning solid long-term gains. Buffett compares this kind of strategy to baseball. Stay patient and wait for the perfect pitch instead of swinging at every ball that comes your way. Still, even the best strategy only works when it's executed by the right people. Core principles provide the framework, but it takes leaders with vision, drive, and an owner's mindset to bring them to life. That's why Berkshire places a strong emphasis on hiring and empowering the right managers. It's a key ingredient behind the long-lasting success the company has enjoyed over the decades. A capital allocation system only reaches its full potential when managed by the right people. That's why the management philosophy and company culture at Berkshire Hathaway are so essential to its enduring success. Warren E. Buffett and Charlie Munger spent their entire careers refining their views on how to choose, motivate, and retain great leaders, often in ways that run counter to conventional corporate thinking. Their leadership philosophy centers on three key traits: integrity, intelligence, and energy. Of the three, integrity comes first. As Buffett often says, if someone lacks integrity, then intelligence and energy become dangerous. This belief was cemented during the Salomon Brothers scandal in the 1980s, although the incident initially involved only one individual breaking a Treasury Department rule. The far more damaging issue was the delayed and inadequate response from company leadership. That experience convinced Buffett that a firm's reputation is never worth risking. As he put it, if you lose money, we'll understand. If you lose reputation, we'll be ruthless. That same long-term mindset is evident in Berkshire's approach to compensation. Unlike most public companies that use stock options or overly complex bonus schemes, Berkshire allows each of its subsidiaries to tailor compensation structures based on what managers can actually control. For instance, at Geico, bonuses are tied to the growth in insurance policies and operational performance. It's a straightforward, sustainable incentive system. Charlie Munger once joked that overly complex pay structures were like letting the rats guard the cheese, a warning against rewarding the wrong behaviors. This long-term thinking also guides Berkshire's famously decentralized management style. Even though the conglomerate owns hundreds of companies and employs roughly 400,000 people, the corporate headquarters has fewer than 30 employees. Buffett refers to this as delegation to the point of abdication, an extreme level of trust placed in subsidiary managers. This hands-off, collective trust approach is especially attractive to entrepreneurial leaders who thrive on autonomy and accountability. A prime example of this is when Berkshire acquired Nebraska Furniture Mart. Founder Rose Blumkin continued to run the store exactly as she always had, no board meetings. No outside consultants, just relentless focus on value and the customer. That trust and respect for her process allowed the business to continue operating seamlessly and successfully. This light-touch management approach even shapes how Berkshire handles difficult decisions. After the Salomon scandal, Buffett encouraged employees to evaluate their choices with a simple litmus test. Would you be comfortable with this action appearing on the front page of the newspaper tomorrow? Rather than relying on thick rulebooks and micromanagement, Berkshire empowers its leaders to do the right thing, especially knowing that they have a strong financial base behind them and Dan T need to chase short-term fixes. Even so, no management philosophy is complete without a succession plan. Rather than trying to find a clone of Buffett, Berkshire's focus has been on creating a culture that can endure regardless of who's in charge. Leaders joining the company are given assurance that the businesses they built won't be dismantled overnight due to sudden restructuring or hasty consulting advice. This stability creates the perfect environment for long-term thinking and business building. In short, Berkshire's success isn't just about savvy capital allocation. It's also rooted in a deep understanding of people and how organizations thrive. Trust, cultural consistency, and long-range thinking have helped Berkshire create lasting value over time. The real key lies in people, the true heart of every successful business. While Berkshire Hathaway's overall structure gives it an edge in many business arenas, nowhere is that advantage more clearly demonstrated than in the insurance business. Starting with the $8.6 million acquisition of National Indemnity in 1967, Berkshire has methodically built one of the largest and most powerful insurance operations in the world. Today, it manages over $165 billion in float, the money it holds temporarily before paying out insurance claims. It can invest in the meantime. What sets Berkshire apart from other insurers is how it uses this money. While most insurance companies treat float as a liability or cost, Berkshire sees it as a form of quasi-permanent equity capital. To put it simply, imagine a bank that receives a $124 billion deposit from a single customer with a promise that it may never be withdrawn. Combine that with steady cash flow from Berkshire's non-insurance businesses, owned to you, and you have a financial engine capable of seizing opportunities that are out of reach for typical insurers. With this kind of financial firepower, Berkshire has become the go-to partner for high-stakes and complex deals. When AIG needed to offload $10 billion in insurance obligations to a company with the strength to handle it, Berkshire was the only one up to the task. Similarly, when the global insurance market was under stress and Lloyd's of London needed a backstop, Berkshire was seen as the safest harbor. Each of these moves only strengthened its reputation. But Berkshire's success in insurance isn't just about financial muscle, it's also about ironclad discipline. That mindset was evident in how National Indemnity responded during a market downturn. Instead of chasing revenue by accepting riskier policies, the company reduced its premium volume from $366 million to just $55 million. In the high-pressure world of public companies, such restraint is almost unheard of. But Berkshire willingly absorbed short-term costs to preserve underwriting quality and reputation. The arrival of Ujet in the mid-1980s took Berkshire's insurance operations to a new level. Despite having no prior experience in insurance, Gen walked into Warren Buffett's office on a Saturday morning and soon built a reinsurance division known for creativity and profitability. His unwavering commitment to risk control, paired with Berkshire's massive capital base, allowed for deals that no other firm could replicate. Even in moments of failure, such as the problematic Gen Re acquisition, Berkshire refused to apply hasty fixes. Instead, it patiently tackled the root causes, starting with cultural reforms and overhauling underwriting discipline. This multi-year effort eventually restored Gen Re to the kind of reinsurance powerhouse Buffett had envisioned. The entirety of Berkshire's insurance machine rests on three pillars: long-term stable capital, strict underwriting discipline, and world-class leadership. With capital to premium ratios 4 times the industry average and the ability to absorb risks beyond the reach of most competitors, Berkshire hasn't just excelled, it has redefined what's possible in global insurance. Rebuilding something similar would require not only time, but also decades of patience and consistency. Under the stewardship of Warren E. Buffett, Charlie Munger, and Uget Jean, the Berkshire insurance engine continues to power forward, steadily expanding boundaries and breaking through old limits. Buffett and Munger Unscripted. Timeless lessons from legendary investors. It sheds light on a sustainable approach to wealth building through a comprehensive investment system, one that doesn't rely on speculation or chasing market trends, but instead is grounded in deep business understanding, disciplined valuation, and smart capital allocation. To Buffett and Munger, stocks aren't just ticker symbols flashing on a screen. They represent real ownership in actual businesses. This mindset allows them to make rational decisions, where being roughly right is far better than being precisely wrong. When combined with tight capital management and partnerships with high-quality leaders, this philosophy forms a solid investment framework for identifying and capturing long-term opportunities. At the heart of their strategy lies the insurance model, a stable and recurring source of investment capital that empowers them to pursue patient, long-term opportunities. Over decades and through countless market cycles, these principles have stood the test of time, all anchored in a core belief: focus on owning businesses that truly create value. That's what enabled both investors to build enduring success that spans generations. Reading Buffett and Munger Unscripted was both eye-opening and refreshing. In a world where financial markets are often overcomplicated and driven by short-term thinking, this book brings us back to the core principles that actually work: clarity, discipline, and long-term value. What struck me the most was the simplicity behind Buffett and Munger's approach. They don't rely on complex models or speculative forecasts. Instead, they focus on understanding businesses deeply, valuing them reasonably, and having the patience to wait for the right moment to act. Their philosophy encourages thinking like a business owner, not a stock trader, which is a mindset that can change how we relate to money and investing entirely. I also appreciated how the book highlights the importance of trustworthy leadership, honest culture, and the power of aligned incentives. It's not just about numbers and returns, but about building something lasting with integrity and clarity of purpose. The insights into Berkshire's use of insurance float as a strategic advantage were another fascinating layer. It showed how vision, when paired with discipline, can build a financial powerhouse without cutting ethical corners. Overall, this book doesn't just teach you how to invest, it teaches you how to think better, act wiser, and make decisions that reflect long-term value. I would highly recommend it to anyone who wants to grow both as an investor and as a rational thinker. And with that, we've explored the distilled insights of this remarkable book. We hope you found it valuable. If you're interested in similar titles, feel free to leave us a review or suggest a book you'd love to see next. You can also buy the book to experience it more clearly, as well as support the author. I will leave the link in the description below for you to easily search. If you like the channel, you can press the like button, share, and turn on the notification bell to receive new content. Thank you so much, Hand. We'll see you in the next one.